A lot of people think they've found a secret way to get rich quick. They think they can just buy and sell based on whether interest rates go up or down. Rates down, buy. Rates up, sell everything. It sounds simple, even tempting, but it's a dangerous illusion. This kind of thinking is all about short-term gains, not long-term wealth. It's like trying to get rich by winning the lottery. Possible, but not likely. The reality is, interest rates are just one small piece of a much larger puzzle. They're like the tides, constantly rising and falling, influencing the vast ocean of the economy. Trying to predict every ebb and flow of the tide is a fool's errand. Instead of chasing quick wins, focus on building a strong financial foundation that can weather any storm. That's the path to true financial freedom. Let's understand how this money seesaw works. Imagine a seesaw with borrowing costs on one end and asset prices on the other. When interest rates go up, it becomes more expensive to borrow money. This pushes down on the borrowing cost side of the seesaw, making it heavier. As borrowing costs rise, businesses and individuals are less likely to take out loans. They have less money to spend and invest. This decrease in demand affects the other side of the seesaw, asset prices. With less money flowing in, the prices of assets like stocks, real estate, even cryptocurrencies tend to go down. This interconnectedness is key to understanding the impact of changing interest rates. The problem with trying to time the market based on interest rates is that it assumes you can predict the future. It's like trying to catch a falling knife. You're more likely to get hurt than to succeed. Even professional investors, with all their fancy algorithms and data analysis, struggle to accurately predict the direction of interest rates. The truth is, the market is complex and influenced by a multitude of factors, not just interest rates. Economic data, geopolitical events, investor sentiment. All these things play a role in shaping market direction. Trying to time your investments based solely on interest rate predictions is like walking through a maze blindfolded. You're bound to hit a wall eventually. History is littered with examples of investors who made big bets on the direction of interest rates and lost their shirts. Remember the dot-com bubble of the late 1990s? Investors piled into tech stocks, ignoring rising interest rates, convinced that the boom would last forever. We all know how that turned out. A spectacular crash that wiped out trillions of dollars in wealth. More recently, the 2008 financial crisis was also fueled by low interest rates, which made borrowing too easy. People took on mortgages they couldn't afford, thinking housing prices would keep going up. When the bubble burst, it triggered a global recession. These examples highlight the danger of relying solely on interest rate predictions. What seems like a sure bet can quickly turn into a financial disaster. Right now, in 2024, we're seeing the ripple effects of the Federal Reserve's interest rate hikes. To combat inflation, the Fed has been raising interest rates, making it more expensive to borrow money in the US. But this also has consequences for the rest of the world. Many countries rely on the US dollar for trade and investment. When the US raises rates, it becomes more expensive for these countries to borrow dollars, impacting their economies. We're seeing this play out in emerging markets, where currencies are weakening and debt burdens are growing. It's a reminder that we live in a globally interconnected world, and what happens in one country, especially an economic powerhouse like the US, has far-reaching implications. So, how do you navigate the choppy waters of fluctuating interest rates and unpredictable markets? The answer lies in adopting a long-term perspective and focusing on what you can control. Stop trying to time the market. It's a loser's game. Instead, focus on building a diversified portfolio that aligns with your financial goals and risk tolerance. This means investing in a mix of assets like stocks, bonds, real estate, and even alternative investments like gold. Diversification helps spread your risk, so even if one asset class doesn't perform well, others can cushion the blow. Remember, when it comes to building wealth, slow and steady wins the race. Think of your financial future like building a house. You wouldn't build your house on the sand, at the mercy of the changing tides. You need a solid foundation of bricks and mortar, something that can withstand storms and stand the test of time. The same goes for your finances. Trying to time the market based on interest rates is like building your financial house on sand. It's unstable and risky. Instead, focus on building a solid foundation by investing regularly, diversifying your portfolio, and managing debt responsibly. These are the bricks and mortar that will protect your wealth and help you achieve financial freedom. While everyone else is busy trying to predict the next move in interest rates, savvy investors focus on something more fundamental: value. These are the Warren Buffetts of the world, who look for companies with strong fundamentals, solid management, and a track record of profitability. They understand that market fluctuations, driven by factors like interest rates, create opportunities to buy undervalued assets. They don't fear market downturns. They see them as a chance to buy great companies at bargain prices. This long-term, value-oriented approach has proven itself time and again, delivering consistent returns regardless of interest rate cycles. Smart investors understand that interest rate cycles are a natural part of the economic landscape. They don't try to fight the tide. They learn to ride the waves. When interest rates are low, they take advantage of cheaper borrowing costs to invest in income-generating assets. When rates are high, they focus on preservation of capital and look for investments that benefit from rising rates, like floating rate bonds. They constantly adapt their strategies, not based on fear or speculation, but on a deep understanding of economic fundamentals and market cycles. Here's the key takeaway. Achieving financial freedom is not about gambling on interest rate swings. It's about educating yourself, developing a sound financial plan, and making informed investment decisions that align with your goals. Don't get caught up in the hype, and don't let fear dictate your actions. Focus on what you can control: your savings rate, your investment strategy, and your financial knowledge. Remember, knowledge is power, and in the world of finance, it's the key that unlocks the door to financial freedom. Interest rates will continue to rise and fall, markets will fluctuate, and the financial landscape will keep changing. But those who are prepared, those who have a solid financial foundation and a long-term perspective, will be best equipped to weather any storm. So, don't be lured by the siren song of quick riches through interest rate speculation. Instead, focus on building your financial fortress, brick by brick, through education, sound investments, and a commitment to your long term financial well being. Remember, wealth favors the prepared mind.